Welcome to Money Matters TV. My name is Paul Michell. I'm a commercial banker, and I'm your host for this show. I'm pleased to introduce our featured guest today, and this is for the entire show. This is Nick Yzzi, and he is a CPA with his firm of Yzzi and Associates. So we're going to be talking about taxes, and taxes, because we are in tax season. Thank you very much.
Thanks for having me, Paul.
Nick, welcome to the show. So we have a whole bunch of things to ask you about the changes in taxes and that type of thing. Starting off with the Trump tax law made sweeping changes and all. And start off in 2018. This is now 2020, but we're talking about 2019 returns. Any updates on there that we should really be looking at?
Yeah, there've been some updates. Usually they're called extenders, and what that means is, and they do this almost every year, they extend a provision that's about to expire.
This is the IRS?
Yes.
Okay.
The IRS, through Congress, extends these provisions. So for this year, the Trump law remains in effect, and with very little changes except regulatory changes, explanations of how the law should be interpreted. But as far as this year, there's some things that have been reinstated. The above-the-line deduction for tuition and fees has been reinstated. There is an educational credit for $2,500.
So tuition is, you go to college, you pay tuition.
College tuition.
And you also have college fees.
And the fees. That's been extended. And you may ask, well, why is there a deduction for tuition and fees when there's also a credit? The credit's more valuable. And that's because there's income thresholds as far as what you can take as far as a credit, and the threshold is higher for the deduction. So if you're not entitled to the American Opportunity Credit of $2,500, then you may be entitled to the tuition and fees deduction.
So who gets that deduction or that credit? The student who has, so let's say, minimal income, or the parents that may be making $200,000 a year?
As long as that student is a dependent, then the parents get the deduction and the credit.
Nice.
Otherwise, it's wasted.
Yeah, that's what I was thinking.
Yeah. Yes.
Here, there, empty hands.
Yeah. So obviously the parents.
Yeah.
Yeah.
Okay. Interesting. Okay. Anything else regarding?
Yeah.
those
Mortgage
changes?
insurance premiums were about to expire.
Mortgage insurance premium.
Mortgage insurance premiums are for those that don't have 10% equity when they buy a home.
Yeah.
So that has been reinstituted. There's if you have debt forgiven under the Obamacare law, that would have not been income. That was about to expire too. So if you had a mortgage debt that was going to be forgiven by the mortgage company, it would become income under most circumstances.
How would a mortgage company? I'm a banker. Don't forgive loans so
because
they become income.
because the borrower is insolvent.
Oh, really?
Yeah. So that insolvency then becomes non-taxable.
But the forgiveness becomes income. I mean, they're insolvent, and
I mean,
now they have a tax liability?
Yes. Yeah, when you have debt forgiveness, that becomes a tax liability. And it's not just residential mortgage interest that would be forgiven. There's other types as well. So yeah, that's taxable income.
Does that happen very often?
Yes. And there's some other provisions where you can get out of the tax liability, aside from this one. If you have, let's say, capital loss carryovers, if you reduce tax attributes of things like net operating loss carryforwards, net operating or capital loss carryforwards, you can end up not having to pay the tax on that forgiveness if you give up those future tax credits. So that's always been the law. This is a special carve-out.
Once again, it sounds like you really need a tax professional to look at your tax situation. I think we should always be repeating that constantly because, wow, that's complicated.
Yeah, and that was one of your other questions. Do you still need a tax preparer to do your tax returns? I mean, I would say for folks who have just wages and maybe some dividends and interest, they can go in TurboTax and they're going to go to some tax-free software and do it themselves.
Yep.
But even for the simpler returns, Paul, what happens is they may sell a home. Okay, that's how do you do that?
Yep.
They may have tuition credits now their children are in college. They may have 529 withdrawals, which get to be a little bit complicated. They could have a capital gain or maybe inheritance from in the inherit IRA. So even for similar circumstances, sometimes those folks have to seek out professional help as well, and it's a matter of knowing when to do that.
Yeah, I was thinking perhaps unless you really feel comfortable doing taxes, have a professional do even your relatively simple return the first time. Nothing changes year 2, 3, 4. Just your your regular income, your mortgage or whatever, that type of thing. Stay with it. But if something significant happens,
Sure.
you should get your professional in again too.
Yeah, and I've seen many circumstances where people come in and I have to file them into return because they forgot to do something.
Yeah.
Didn't take a credit, didn't take a deduction. And sometimes you cheat yourself by trying to save $300 or $400.
I was going to say, relative to saving, $1,000 or a couple of $1,000 perhaps, if you spend a few $100s with a professional, you're going to be way, way, way ahead.
That's my biased opinion, yes.
Yeah.
Yeah.
So, how about this other thing I've been hearing about is this Secure Act, the Retirement Enhancement Act of 2019, affecting retirement accounts. When is that affected? What does that mean?
Yeah, the Secure Act, and that's an acronym for setting. I have to read this because it's so confusing. Setting every community up for Retirement Enhancement Act of 2019, and it did a few things. It provided incentives to employers. So if an employer sets up a simple plan or 401k, they can now take a tax credit. It used to be $500 of $5,000 for 3 years, or $15,000 to cover the cost of the startup plans to open up a retirement plan.
Who takes the credit?
The employer.
The employer. Okay.
Okay, so that's one provision. And then there's also.
This would be like a 401k plan that the employee is going to actually totally fund.
That's right. That's right.
Maybe a match from the employer.
Yeah, it doesn't matter who funds it.
Okay.
But as long as they set up the plan,
I see.
those startup costs will generate a tax credit.
So that's a real incentive.
Dollar
it
for
sounds
dollar,
like.
sure.
Yeah.
And then if they enroll an automatic enrollment for the contributions from the employees and the employer, they get another $500 credit a year for 3 years. So the credits there are significant.
Wow. Is there like a minimum number of employees involved type of thing? If I had my own company and I had 4 employees, could I do it?
Not necessarily, no. There's no
Okay.
minimum. And then there's some enhancements for employees and individuals, I should say, too. And one of the big ones was for long-time part-time employees, you can establish a retirement plan and make contributions if they've worked 500 hours or more for 3 consecutive years. The other part of the employee individual
That's 10,
side.
10 hours a week.
Yeah, so it's pretty
Okay, so it's-
minimal.
Yeah.
The other thing is the required minimum distribution.
Under 70.
Yeah, used to be 70 and a half, now it's 72. That's another big change. And the other big change for individuals was that the maximum age for contributions used to be, to a traditional IRA, used to be 70 and a half. Now there's no limit. You can continue deducting as long as you have earned income,
yeah.
obviously.
Okay.
Then the other part, the inherited IRAs, which you probably heard the most publicity about, would be what they call the stretch IRAs. An integral part of financial planning, particularly for wealthy individuals, was they have these IRAs, they don't need them to live on, and they don't even need them for retirement. So the plan was to get those to their children, and they could stretch it out over the lifetime of the children. So when someone inherits an IRA from a decedent, they could either take the money immediately, they could take it over 5 years, or they could take it over their lifetime,
Wow.
which would be another 40, 50 years, let's say. That law has changed, whereby an inherited IRA has to be diffused within 10 years. And why do they do that? Well, because the government expects that in the next 10 years they're going to raise $16 billion on that provision alone. Now, there's some exceptions to that. If a spouse inherits it, the 10-year rule doesn't apply. If a minor inherits it, 10-year rule doesn't apply. And if a disabled person inherits an IRA, the 10-year rule doesn't apply. So they were the provisions with respect to this called the stretch IRA, and now they can't be stretched for longer than 10 years. What it does do is open up a door for the conversion of traditional IRAs into a Roth IRA. And if you combine that sometimes with a person who's charitably inclined, what they could do is they could take a traditional IRA, convert it to a Roth, it becomes income, and then they offset that by a charitable deduction. So the charitable deduction offsets the Roth income that they have to pick up. And then when they inherit, when the children or the beneficiaries inherit the Roth IRA, then there's no tax. So there's some planning opportunities here that have been opened up because of the inherited IRA changes.
Let me ask a question that's not totally tax oriented, but you're talking about IRAs and that type of thing. Over the last few years, and being a banker, I deal with small, medium-sized businesses. Been a lot of talk about financing a business with an IRA.
With like a self-directed IRA.
I guess. I mean, they're taking money
yeah.
out of the IRA and put it into buy the dry cleaner.
Just to withdraw.
The dry cleaner.
I mean, I don't normally recommend that because if they're under 59 and a half, they have to pay tax and a 10% penalty. I think it's just a lot cheaper to go get a loan from a bank, if that's what you mean.
Yeah, well, I mean, it's supposed to be an investment of the IRA, so it's not a withdrawal. So if I have $200,000 in my IRA, instead of buying stocks and bonds with it, I'll transfer the stocks and bonds
Into my business.
Into my business.
That's a self-directed IRA. Yeah, there's definitely,
It's legal.
yeah, absolutely. Yeah, you don't have to just put your IRA into Vanguard, let's say.
Right, right.
You can put it into your business, and
Okay.
there's obviously
Yeah.
rules and regulations to follow to avoid
Yeah, yeah.
abuse.
But it's the risk.
absolutely.
Of, the risk of the thing of you're putting all your retirement savings into something that may not pan out.
Yes.
You may lose your, but
Yeah.
you can do it if you want.
Sure.
Okay, interesting. How about the old thing about the last couple of years about the mortgage interest and all? It's only so much. Or just real estate taxes, I guess it is.
Yeah, the real estate, because of the Trump law, I mean, they lowered tax brackets, they've doubled the standard deduction, but they've eliminated the personal exemption, which was $4,050 for each dependent, including children. But conversely, they increased the child tax credit from $1,000 to $2,000. So some people lost, some people won because of the tax changes. When it comes to what you just mentioned, I'm sorry.
The mortgage.
The mortgage, the tax deduction.
Taxes. Real estate taxes.
That was a key element of the proposal because it's limited to $10,000 a year.
Yeah.
So if you're in a high tax state like New Jersey, New York, California,
Sure.
you've really lost. If you have, let's say, a home with a high mortgage, and you also have a second home down at the shore, you're also limited. And I've had many clients who can only deduct the $10,000.
Yeah.
And even some of the states, they tried some creative ways to call it something other than a tax. So
Oh,
that
yes,
they're,
I've seen that.
yeah, and the administration and the IRS says, no, we're not going
Yeah,
to
they set up
go
some
along
kind
with
of
that
charitable
technique.
thing or something like that. Yeah. Yeah.
Yeah.
Getting back to the IRAs, we do have a question from somebody in our audience.
Sure.
Okay, about IRAs, and it is specifically, what are the advantages and disadvantages of a regular IRA as compared to a Roth account, tax-wise?
Okay. A traditional IRA means that you can put $6,000 a year under the current law into an IRA and get a tax deduction. And that tax deduction at your tax bracket gives you the tax benefit that you derive. So it's deductible. So what happens, you get the tax deduction, you get the tax benefit
So you put in $10,000, let's just say,
over time.
and how much of a deduction do you get from your income?
Well, depending on your bracket, you could be at the top rate of 37%. Okay, so you would derive $3,700, but you only put in $6,000 a year.
Right. Okay.
7 if you're 50 or older under the catch-up provision. But what happens is the money accumulates over time. All the dividends and interest, including the principal, are taxed when you withdraw it.
The income during that time is not taxed.
That's right. So if you had investments of $100,000 over the years, and now they're worth $300,000. When you start to withdraw those funds, everything is taxable.
Right.
Okay, so you get a deduction going in, but you have to pay full tax for the earnings buildup and the principal. The principal is now taxable because the principal is deductible.
Right.
That's a traditional IRA. A Roth IRA means that you get no deduction today, so you're giving up the tax benefit. However, the earnings buildup that you put $100,000 into a Roth IRA,
Still tax-free?
still tax-free. The entire, not only is the principal tax-free because you never got a deduction, but all the earnings are tax-free as well. So that's a tremendous benefit as long as the law doesn't change.
So when you start withdrawing from the Roth thing, you don't pay
Tax-free.
It's tax-free income.
And there's no required minimum distributions.
Yeah.
And if you wanted to take the money out after 5 years, you're allowed to do that without a penalty. Some people do that to buy a home. Maybe that's not a good idea. Maybe it is, depending on circumstances, or it could be an emergency. So I would normally recommend for someone younger, you definitely get into a Roth IRA. But even for older people, there have been people who have money in traditionals, who if they, and you should do this with a lot of calculations and thought behind it, but if you think your tax bracket is going to be about the same or higher than when you retire, which often happens, than when you're working, then you may want to consider converting a traditional IRA to a Roth. And what that means, you have to pay tax on it now. Okay, but if you're going to live long enough, you have to figure out, and it could be risky. Over the long term, it may be much more beneficial to not pay taxes down the road, or have your beneficiaries, like we discussed recently, that they won't have to pick up the tax down the road.
Yeah.
So sometimes the parents would rather say, "I'll pay the tax now, and I'd rather pass it on to my children tax-free by converting it from a traditional to a Roth IRA.
Yeah. Nice parents.
Yeah, one other thing you can do when you talk about IRAs, if you're in a 401k, let's say you work for a company, and if you're married, your income's over 193,000, you can't contribute to an IRA. But there's something called a backdoor Roth IRA, which enables someone who's not entitled to an IRA contribution because their income is too high to be able to take $6,000, put it into a non-deductible traditional IRA, and then the next day roll it over into a Roth IRA. And it's a backdoor way of putting money into a Roth IRA that you couldn't do otherwise.
Interesting. Again, a little complex. Switching gears
It is
a little
complex.
bit. Gears a little bit. Let's go talk about the front door. Apparently, many individuals have been victims of identity theft involving their tax returns. What must a person do if that occurs? And I'm going to ask the question of, how does that happen?
It happens in a variety of ways. People have information on their computer. Sometimes a target of all those people out there who try to steal Social Security numbers with the dark web, through the dark web, try to target financial institutions who have folks' Social Security numbers, their accountants, their lawyers.
Wow.
So we have to be very careful about that type of thing as professionals. But if you are subject to identity theft, number one, you should call the FTC, identitytheft.org.
Yeah.
You need to contact one of the 3 reporting agencies, the credit reporting agencies, Experian,
Yeah.
TransUnion. And then you also have to contact your financial institutions. On the IRS side, you need to prepare an identity theft affidavit. It's form 14039, and you submit that to the IRS, and they'll contact you, and they'll give you a PIN in the future. If you're going to file electronically in the future, you can't do it until you have the PIN number the IRS assigns every year to you.
Right. Different number every year.
Yeah, yeah.
Wow. So how does that happen? So and what are they doing there? They're taking your Social Security number and they're filing a tax return and getting like a refund in your name, but you never see the check.
Correct. I mean, and there's sophisticated schemes. I mean, there have been some instances where they take last year's return and they file it early in the tax season before you get a chance to file it.
Sure.
And sometimes they're electronic, but usually there have been checks. They arrested a person a few years ago where he was like a courier for some of these groups, and he would go into mailboxes knowing when the checks were going to arrive.
Yeah.
And they would steal the checks out of the mailboxes knowing that they would check them every day. And they found him with 50 IRS refunds. So it's become very sophisticated. Sometimes it's manual checks, sometimes electronic. Most of it's coming from overseas,
Yep.
but it's a real problem.
So how could you check on yourself electronically? Something you do, I don't know, once a month or something like that?
It's always good to maybe you get the LifeLock, or you check your, checking your bank statements is always advisable.
You can check them online typically these
Sure.
days.
Yeah. But you also have to be careful about changing your passwords periodically. You can't just have the same password for years. So
I know.
you need to be prudent about that and exercise some due diligence.
Yeah.
And we're all guilty, including myself, of having a tendency to use the same passwords for a bunch of other
Yeah.
different accounts, and that's a mistake.
Yeah. Brutal. So what's a new investment of the Trump tax law involving opportunity zones? I've heard some controversy about opportunity zones,
Yeah.
some wealthy people taking advantage of things like that. How's it supposed to work?
Well, the criticism there is the gentrification of neighborhoods, because you have people in their neighborhoods, particularly in distressed communities, and the criticism is, we're going to come in and we're going to redo this whole neighborhood. We're going to force people out of.
Like Camden.
That's right. Yeah, an opportunity zone. I mean, it's a good concept. The idea was to build up those distressed communities and provide investments that will help the community itself and help the people, not drive them out. But there's 8,700 opportunity zones in the United States, and that involves about 31 million people who live in those zones. The idea is, as an investor,
That's 10% of the U.S. population.
Yeah.
Roughly.
sure, and the idea is I would invest a capital gain. I could have a capital gain from an investment.
Okay.
Let's say it's $200,000. If I take that gain and I invest it in an opportunity zone fund that invests in a real estate venture of some type in an opportunity district, okay, If I take that $200,000 capital gain and invest it in an opportunity fund, I can defer the tax on that gain until December 31st, 2026. And that tax won't be due until April 15th, 2017. Okay, so that's 7 years.
Yeah.
Okay, as long as I keep the money in there. If I pull it out earlier, then I have to pay tax on it. That's number one. I get a tax deferral on that $200,000 gain. Or it could be a $2 million gain.
Yeah.
And it doesn't matter where the gain is coming from. It could be securities, it could be real estate, whatever it might be. If I hold on to that investment, that Opportunity Zone Fund investment for 5 years, I get a 10% increase in my basis. In other words, that $200,000 gain is going to be decreased by 10%.
Yeah.
So now the gain's $180,000 I'll have to pay tax on in 2026.
Right.
And then thirdly, if I hold on to it for 10 years, assuming the value, the underlying value of the investment goes up, I won't have to pay tax at all on the increase on the $200,000 that I've invested. So there's tremendous tax benefits to the investor that hopefully will turn around to build up those communities.
Yeah. Well, as a banker, I always look at does the investment really make sense? I mean, just because it's going to an opportunity zone with all these good feelings and stuff, I mean, if I had $200,000, I'd want to put it into something that I knew was going to increase in value.
And that's
opposed to a
a
risky
great
neighborhood.
question, because it is risky, it's new, you don't know if the investment will go positive or go negative.
Right.
So you have to really look at the underlying investment more so than the tax ramifications, because it's so new. And someone once recently said that I read, you don't want to let the tax tail wag the investment dog. So there is risk
There's
to
an
it.
image there,
Yeah.
yeah. Well, how about hiring your child in your business to help fund tuition? That's an interesting concept.
Yeah, as long as it's legitimate. And I'll give you a scenario. I own a business. And you see this a lot with car dealers. You notice, particularly at night at 11:30, there's all these commercials on car dealers. Some of them are pretty hokey.
Yeah.
And some of them include children.
Oh yeah, the
Okay.
16-year-old.
Yeah, well,
Hawking.
there's a reason for that. There's probably more of a tax reason than a practical reason, because you can hire, that's someone who's maybe not in college, but let's say they're in college. Theoretically, it's a way to help with the tuition. You can pay your child, if it's legitimate, about $40,000, and you can take, and as long as you're not claiming them as a dependent, even though you don't get an exemption deduction for it anymore, they're on their own. They don't need grants and they don't need student loans because there's more wealth there. You pay them about $40,000. You could take $6,000, put it into an IRA, whether it's Roth or traditional. They would get the American Opportunity Credit of $2,500. They would get the standard deduction of $12,000, and they'd have about $25,000 or $26,000 left over to pay tuition. At the end of 4 years, they'll have $24,000 in their IRA. They wouldn't have paid any tax on $160,000, and the parent who owns the company would have deducted the $40,000 in wages.
So whose idea was this? I mean, it sounds again really complex and esoteric. And
It's legitimate. It's called
Congress,
tax planning.
part of the.
Well, it's just a matter, a deduction is allowed for salary. Can your child work for you? Yes.
Okay.
Would that be a good time to pay them a salary when they're in college? Yes.
Okay.
So it's not a provision, it's just a planning technique.
I see. No regulation, nothing that's come up in the last
No.
5 years of this. This is just somebody maybe.
Now, if they're
suggested
home
this-
for the summer, they're at the beach and you're paying them, I mean, that's not legitimate.
Right, right.
Then it could be all, unraveled.
Yeah.
Yeah.
As we wrap up the show, Nick, any last minute couple suggestions?
I think as a general rule, you want to be diligent in trying to lower your tax liability. None of us have. I wish I had the quote. In fact, here's the quote here on the back of my card.
Okay.
Anyone may arrange his affairs so that his taxes shall be as low as possible. This is from a judge, learned at hand. Famous judge with a lot of quotes.
Yeah.
He is not even bound to choose that pattern which best pays the Treasury. There's not even a patriotic duty to increase one's taxes. Over and over again, the courts have said there is nothing sinister in arranging affairs as to keep taxes as low as possible. Everyone does, rich and poor alike, all do it rightly, for nobody owes any public duty to pay more than the law demands. So you should try to get your taxes down,
Yep.
and that requires planning in advance, not after tax season has ended,
Yep.
because then it's too late to do most things except maybe fund an IRA by April 15th.
Right.
So you want to just do that
Or-
and consult with a professional.
File an amended tax return?
You could always do that, but if you want to plan to get your taxes down in 1 year, you need to do it during the year, not after the year expires.
Okay.
Okay, so
Good.
do some planning. I guess that's the idea.
That's terrific. Nick, some great suggestions, great ideas, great explanations. And you can never end with the explanations. Thank you very much.
Thank you for having me.
And that ends our show. So I'd just like to tell our audience that our next guest will be Sam Silverman. He's with Markham LLP, which is a CPA firm. And just remember that on this show, your money matters.